Welcome to a deep dive into something, well, profoundly tangible in a world that often feels anything but precious metals.
hmm
Today, we're delving into some fascinating research that seems to point to a really profound shift underway in the markets for gold, silver, and platinum.
Yeah.
And this isn't just about, the daily price charts. It's about deep structural changes, evolving global power dynamics, and maybe why these metals are becoming, well, increasingly crucial.
Exactly. And our deep dive today will explore that complex interplay. The fundamental demand, the technical patterns, and these powerful geopolitical currents that are shaping the values of these metals.
Right.
You'll hear insights and forecasts from a whole range of respected experts, people like Rick Rule, Mike Maloney, Andy Schechtman, Keith Neumeyer, and quite a few others.
Okay.
Our goal really is to zero in on the most crucial insights so you can truly understand what's actually unfolding in these vital markets.
All right, let's kick things off with gold then. It often acts as a sort of bedrock in what feels like an increasingly unstable financial system.
Yeah, the traditional safe haven.
Exactly. So when we look at what influences its price, a dominant factor seems to be this diminishing faith in fiat currencies. Rick Rule makes it very clear. Gold's price movement is directly tied to people's belief, or maybe lack of belief, in paper money, especially the U.S. dollar.
And Michael Oliver really drives this home, doesn't he? Pointing to the U.S.'s, well, let's face it, unsustainable debt and deficits.
Yeah.
I mean, adding over $1 trillion in debt every 100 days, that's not just large. It's a key driver of that skepticism you mentioned.
And what's particularly fascinating here is how that directly connects to the broader geopolitical shifts, right? And this whole ongoing trend of de-dollarization.
Absolutely. Michael Oliver highlights the dollar index's collapse, first below 104, then 96. Now, this index, for listeners who might not follow it closely, it's a key measure of the dollar's strength against other major global currencies. So when it drops like that, it's not just a number dipping, it signals a profound loss of global confidence, not just in the Fed's ability to, engineer a soft landing, but maybe in the very structure of the post-Bretton Woods system itself.
Where the dollar has been king for so long.
Exactly. It's more than just a currency fluctuation. It feels like a systemic tremor, really.
Okay, so if that's the core problem, this trust eroding, what's the immediate impact we're seeing? Where's the capital going?
Well, Michael Oliver suggests that capital isn't just chasing profit anymore. It's moving towards tangible assets like gold for preservation.
Right, protecting wealth.
Exactly. And this isn't just, individual investors making moves. Silver Slayer notes that even the Bank of England is quietly doing stress tests for U.S. dollar shocks.
Wow.
Which indicates that these global financial guardians are actively hedging their bets against potential instability in the world's reserve currency. It's a huge tell, isn't it?
It absolutely is. And if you connect that to the bigger picture, you see this strong central bank buying, institutional buying, backing it all up.
Yeah, both Silver Slayer and Andy Schechtman report that. Consistent gold purchases by central banks, solid inflows into gold ETFs.
And Andy Schickman shared a pretty powerful statistic, didn't he? Since November 2024, the U.S. has actually become a net importer of gold.
Yeah, bringing in nearly $100 billion worth. As he puts it, the biggest money in the world understands it. Something fundamental is shifting. They're quietly accumulating the physical metal.
And this whole erosion of trust, this flight to tangibles, it's not just a Western thing, is it?
Not at all.
In fact, a massive driver, often overlooked perhaps, is demand coming from Asia. Alistair McLeod talks about really robust demand from countries like China and India.
Right. Driven by, what, limited other options?
Yeah, scarcity of attractive investment alternatives, low deposit rates. He estimates an astonishing annual flow of over $2 trillion into gold from these regions alone.
$2 trillion. Wow. And why are they accumulating physical gold at such a rate? McLeod explains that central banks are getting increasingly unwilling to extend bullion leases.
Meaning they don't want to lend out their gold anymore.
Exactly. They're actively seeking to reclaim their physical gold reserves. It's about securing the actual metal, not just paper claims on it.
Interesting.
And Andy Schechtman takes this a step further. He says gold is quietly being reintegrated into the monetary system.
Reintegrated. What does that mean practically?
Well, he cites Judy Shelton, who mentioned that former President Trump has publicly said, he who has the gold makes the rules.
Okay.
And apparently expressed interest in issuing gold-backed 50-year treasuries, maybe by July 4th, 2026.
Sure.
Now, this isn't just an investment trend. It feels like a strategic repositioning at the highest levels.
Right, hinting at a potential structural change to how global finance works.
Potentially, yeah.
So, okay, with all these powerful forces at play, what are the experts actually forecasting for gold's price? Let's talk numbers. Medium term, say 2026 to 2030.
Well, Rick Rule suggests that if the dollar declines significantly, say 75% over 10 years, mirroring what happened in the 1970s,
Yeah.
the gold price could move up maybe fourfold from current levels, or possibly threefold. He hedges a bit.
And looking a bit closer, say end of next year, 2025.
Andy, over at Finding Value Finance, he suggests we could see $4,200 gold by the end of 2025 if historical patterns repeat.
But it's not all one-way traffic, is it? There are contrasting views.
No, absolutely not. And that's healthy. Citibank analysts, for instance, Silver Slayer mentioned this. They forecast gold consolidating above $3,000 in the coming quarter.
Okay, still high.
Still high, but then potentially declining below that level in the second half of 2026, maybe falling into the $2,500, $2,700 range.
Right, so a difference of opinion there.
Definitely highlights the range of views. But I'd say the overall sentiment from many of our sources seems to point towards significant upside potential.
Yeah, it feels like the weight of factors like the debt and central bank actions keeps pushing towards tangibles. Okay, let's move on to silver.
Ah, gold's little brother. Or maybe not so little anymore.
Right, it has its own powerful story. It's both this industrial powerhouse and, increasingly, it feels like a monetary pressure valve.
Definitely.
So what's driving silver's price dynamics? First off, there's just this, well, insatiable industrial demand.
It's huge, often underestimated.
Totally. Zirada Hindi highlights its role. Second most used commodity globally after oil, critical for solar panels, electronics, medical stuff, EVs.
EVs use almost double the silver of conventional cars, right?
Exactly. And solar panels alone, 5,500 tons of silver consumed in 2024. Plus, now you've got emerging demand from AI data centers.
That's a new one, adding even more pressure.
And get this, Silver Breakdown mentions Warren Buffett's Berkshire Hathaway Energy is pouring billions into renewables and grid modernization.
Which quietly soak up a ton of industrial silver.
Precisely. A quiet giant consuming huge amounts.
And this relentless industrial hunger creates a really critical situation, this deepening supply deficit crisis.
Yeah, tell us about that.
Well, Zirada Hindi, Keith Neumeyer, Clive Thompson, they all confirm it. 5 consecutive years of supply deficits. That's 2020 through 2024.
5 straight years.
And in 2024, demand exceeded supply by a staggering 160 million ounces.
Yeah.
This isn't just a temporary blip. It's a profound structural issue.
And it's hard to fix quickly, right? Mining isn't easy.
Exactly.
Yeah.
Rick Rule points out new primary silver mines are rare. Most silver, like 70%, comes as a byproduct of mining other metals like copper or lead.
So you can't just decide to mine more silver easily.
Right. Plus, Zirada Hindi adds that major existing mines are maturing, they're depleting, like India's Sindhazar Kurd mine, projected to end operations by 2029.
Wow.
And finding and developing new mines. That takes 8-10 years. So it's a very real long-term supply problem we're looking at.
Okay, so scarcity is the word. How is that affecting the paper market, the futures market?
Well, what's particularly compelling is how this scarcity is starting to really expose vulnerabilities there. Andy Scheckman tells us silver and platinum are the 2 most shorted commodities on Connex.
Meaning lots of bets that the price will go down.
Exactly. But what's perhaps even more telling, according to both Andy Scheckman and $2 Investing, is the situation at the LBMA, the big London bullion exchange.
What's happening there?
They have the lowest free float of silver in recorded history. Now, free float is basically the amount of readily available physical silver in their vaults, stuff not already promised to someone else.
And how low is low?
Just 155 million ounces. That's less than a single day's trading volume on these exchanges.
Less than a day's worth. That sounds precarious.
It signals extreme scarcity, very tight supply. Think about a major retailer having less than a day's worth of product on its shelves.
Right.
And then Salivate Metal, Andy Scheckman, Rick Rule, they all highlight that lease rates for borrowing silver have just soared, multi-year highs.
Lease rates, like interest rates for borrowing the metal.
Exactly, hitting 6%, even 8%. If that rate skyrockets, it means physical silver is incredibly hard to find, and anyone who needs it is getting desperate.
And what does that suggest?
Well, Andy Scheckman and Mario Ineco suggest this points to the big bullion banks potentially losing control of their short positions. They might be getting squeezed and forced to buy back metal to cover those shorts.
Okay, so the paper market is under stress. How does that actually play out on the ground with the physical metal?
Great question. This situation is really being amplified by disintermediation and direct physical drainage.
Disintermediation, meaning bypassing the middleman.
Exactly. Keith Neumeyer from First Majestic Silver, he explains that producers like his company are actually taking some of their production and directly minting it into coins and bars.
So it never even hits the big exchanges.
Right. They're completely bypassing the traditional banking channels, COMEX, LBMA,
Hmm?
removing that metal from the system.
Ah,
And he also notes that large buyers, especially from Asia, are now sourcing semi-finished products, like door bars, basically unrefined ingots directly from the miners themselves,
cutting out the exchanges entirely.
which causes silver to, as Neumeyer puts it, disappear from all public reporting. Because it never enters those transparent exchange systems. It's a quiet but really significant drain of physical metal out of public view.
Wow. And then on top of all that, you've got geopolitical factors adding fuel to the fire.
Always. Silver Slayer reports that BRICS nations, Russia included, are showing more interest in silver.
I heard Russia's central bank is actually going to start buying physical silver for state funds.
That's the report, yeah.
Yeah.
For the first time ever. That's a pretty significant move for a major central bank.
Definitely.
And then Silver Slayer and Manico 64 mentioned the potential impact of former President Trump's threatened 30% tariffs on Mexican and European silver imports, possibly starting August 1st.
Which just adds more uncertainty and volatility, right?
Absolutely. Keeps the market on edge.
Okay, let's talk value relative to gold. The gold to silver ratio. Where does that stand?
Right. That's a key indicator many watch. Zeroda Hindi states the current ratio as of June 2025 was around 92 to 1.
Meaning it takes 92 ounces of silver to buy 1 ounce of gold.
Correct. Which suggests silver is significantly undervalued relative to gold, historically speaking. But Keith Neumeyer makes an even more compelling point.
What's that?
He talks about the geological mining ratio, the actual amount of silver you find in the earth for every ounce of gold.
And what is that ratio?
It's closer to 7 to 1.
7 to 1, compared to 92 to 1 in the market.
Exactly. It implies a massive undervaluation for silver right now compared to how abundant it actually is relative to gold in the Earth's crust. Suggests huge potential for silver to catch up.
Okay, so given all the demand, the deficits, the market stress, the ratio, what are the price forecasts for silver looking like? Near term first.
Well, things could get volatile fast.
Yep.
Andy Schechtman said recently he would not be surprised to see $40 later this week.
This week. Wow.
And Michael Oliver believes if silver just touches $37 again, it will be gone, meaning it'll accelerate upwards very quickly.
And Silver Slayer's take.
He echoes that, saying any silver under $40 is basically a gift.
Okay, looking out a bit further, say end of 2025.
Andy Schechtman again would not be surprised to see $50 later this year. And he adds, if silver closes above $41, he thinks the sky's the limit.
And Michael Oliver.
He sees a very strong chance of silver taking out those old dual highs around $50.
The Hunt Brothers spike and the 2011 peak.
Right. And potentially moving into the $60, $70 range, maybe even doubling in the next 6 months.
Doubling. Even the more conservative Citibank forecast, cited by Silver Slayer, sees $43 plus in the next 6-12 months.
Right. So even the cautious outlook is pretty bullish.
And medium term. 2026 to 2030, this is where it gets really interesting.
It really does. Rick Rule expects silver to handily take out those prior all-time highs, which in inflation-adjusted terms would be around $80, $85.
Okay. And Mike Maloney, he's known for some big calls.
He is. Analyzing a giant cup-and-handle chart formation that's a classic bullish technical pattern, he predicts a move well above $150.
Wow.
Possibly $300, $500. Or even, get this, $660 if it enters what he calls a same type of bubble as 1980 when measured against other assets.
Those are astronomical numbers.
They are. Silver Slayer also chimes in, saying triple-digit silver is not out of the question.
And Keith Neumeyer, the miner.
He points to $38 as the magic number for silver to go ballistic. He says there's basically no lid on the price before $50, and even then, still a long ways to go over the next decade.
So the consensus, or at least a strong theme, is extreme upside potential driven by that supply-demand crunch.
That seems to be the core argument, yes.
Okay, finally, let's briefly touch on platinum. It's often a bit more specialized, right? Smaller market, very specific industrial uses.
Yeah, Precious Metals Outlook described it quite well, I thought, as a specialized high-performance submarine.
Okay, meaning essential for critical, high-tech industrial and military tasks.
Exactly. And similar to silver, it's also experiencing significant market stress. Andy Seckman notes it's the second most shorted commodity on COMEX, right behind silver.
So also heavily bet against.
And under great stress at the futures level, as he puts it. Precious Metals Outlook also points out that platinum's lease rates are skyrocketing.
Just like silver, indicating a scramble for limited physical supply.
Precisely. And we're seeing institutional interest there, too. Finance Log reported that billionaire investor David Bateman bought 7,000 ounces of platinum just back on July 2nd.
Which highlights, again, strategic positioning by some very smart, deep-pocketed capital in this unique market.
Definitely a signal worth noting.
And what about recent price action? Has it been moving?
Yeah, Peak Prosperity reported that just on July 11th, 2025, platinum was up $57 in a day. That's like a 4% move. So some strong momentum there recently.
So what's the fundamental rationale? Why would big investors like Bateman or someone like Rick Rule be moving into platinum now?
Well, Rick Rule provided a key investment rationale that really sums it up neatly. He said he purchased physical platinum and palladium simply because those metals were priced below the total cost of production.
Ah, the classic value play based on mining economics.
Exactly. It's not just about charts or sentiment. It's a fundamental bet that prices have to rise eventually because producers can't keep selling at a loss indefinitely and still, dig the stuff out of the ground.
Right. It signals an almost inevitable rebalancing long term.
That's the argument, yeah. Strong long-term upside potential baked in by the current economics.
Okay. So pulling all these threads together now, gold, silver, platinum, what does this all mean for you, the listener, the learner, trying to navigate these, well, increasingly complex markets?
Yeah, what's the big picture takeaway? I think the overarching theme that really emerges from all these sources is this idea of a great rotation.
A great rotation.
A significant shift away from the, let's say, eroding stability of traditional fiat systems towards the tangible safety and the utility of hard assets.
Right. Dollar weakening, persistent inflation, geopolitical turmoil.
Exactly. They're all collectively driving investors and even central banks, as we've seen, towards these alternatives as trust in, paper promises kind of crumbles.
The physical nature of gold, silver, platinum offers a refuge.
Precisely. It transforms them from just being niche investments into potentially essential components of wealth preservation, economic resilience. This isn't just about chasing investment returns anymore. It's really about trying to safeguard your wealth from a global financial system that's beginning to show some pretty profound fractures.
It definitely feels like we're witnessing a profound shift in global finance, doesn't it? A real reevaluation of what truly constitutes value. So the question for you, listening then, is this. In a world where the very definition of money seems to be being redefined right now, how are you positioning your own wealth for whatever future is coming?
And remember, every great market rotation, it usually begins not with a bang, but more like a whisper.
Yeah.
And based on what we're hearing, we're somewhere between that quiet accumulation phase and growing institutional awareness. The real rush, maybe it hasn't even begun yet.
Right. As one of our sources put it, by the time the bell rings, the train may already be gone.
Exactly. So this isn't just a bet on metals prices going up. It's maybe more like a reallocation of worldview.
A bet on scarcity over excess.
Yeah, on history over hype, maybe on reality over narrative.
Yeah.
Something fundamental.